Welcome to the Dream Huge podcast, where we'll talk with real estate investors, entrepreneurs, business leaders, athletes, and more to inspire you with their success stories so you can work hard, never give up, and dream huge. And now, let's start the show.
Yo, what's up, everybody? Welcome to the Dream Huge podcast, man. Super excited for this one today. We love to share success stories from other huge dreamers, folks in the real estate business, entrepreneurs, movers, shakers, influencers, and more. And hopefully these stories will help to motivate and inspire you to also dream huge, baby. And today we are joined by JP for 3, the #1 selling agent in only 3 short years on the entire Mansfield Board of Realtors. What's going on, JP?
Pete, what is happening, my man? It is Monday. We are doing good. I spent some money and bought an investment property today. It's been a great Monday. It's been a great Monday so far, man. So I'm doing excellent. I am doing great. But I do have one question, though. Pete, how are you doing, my man?
Fantastic, as always. Great Monday as well. So yeah, ready to jump in here. Thank you for taking the time, JP. So we have Hannah Kesler. Hannah is with The Money Multiplier. You can check them out at themoneymultiplier.com. And we're going to dive in, do a deeper dive on infinite banking and what that looks like. So if you want to start, Hannah, let's start with a brief overview of what infinite banking is, and then we'll begin the deeper dive.
Absolutely. And I'm excited to be here and even more excited to talk about my favorite topic, money. Money.
Okay. I love it. So we're going to help folks out today, hopefully. So what do you got?
Absolutely. I'll preface the conversation by saying this. All of these teachings come directly from this black book, Becoming Your Own Banker. So everything that we teach and talk about is coming directly from here. So I highly recommend that y'all need to add that to your wealth building library. But to give this whole concept like a 30,000 foot overview, all it truly is, it's taking back the control of the banking function in your life. Because here's what Nelson Nash teaches us. He says, hey, you want to be in 2 businesses in your lifetime. The first one is the one that you're passionate about, gets you up out of bed every day, supports the family, supports the lifestyle. But then the second business is the banking business, the business that finances everything throughout your life. And that's what this concept here is talking about, is taking back the control of that banking function. Because I don't care what y'all do, you need to make some money to live on this God-given earth we call America. And then what we do with that money, we're kind of given like 3 options. Number 1, you can go put it in a local bank because, well, that's where they keep the money at. Or number 2, I could stick it in my sock drawer, maybe dig a hole in the backyard, leave it underneath my mattress. Or number 3, I could leave it with a financial advisor who thinks they can manage my money better than I can. And that's kind of all the options that we're left with. So instead of me keeping my wealth in somebody else's bank, Bank of America, Wells Fargo, et cetera, and they're using my money to make a good living off of my money, I'm just flipping that script. I'm making my deposits into my privatized bank, and then through there, I'm the one who makes the interest, the profits, and the dividends now on that money. And so y'all are probably thinking, well, what is this privatized bank, Hannah? Did you have like $1 billion and you went over there and just opened up your own bank? No, it's not the traditional bank that you are thinking of. It's a policy, a whole life insurance policy. That's the vehicle that we're using. And now, before I even get deeper into it, I know some folks are thinking, well, Hannah, I know everything there is to know about whole life insurance because Dave Ramsey and Susie Orman, they told me whole life insurance is the worst place to invest my money. And I get it. That's why I took my dad literally 2 years to start this stuff, because he was a Dave Ramsey's baby step follower. But it's not a whole life policy they can go and just buy off the shelf from your brother-in-law that sells life insurance. No, it's got to be designed specifically specifically for this infinite banking concept. And what I mean by that is when I pay my premium, I like to call them my premium deposits. When that premium deposit goes into this policy, immediately, my definition of immediately is within 30 days, I have access to cash value in there that I can pull out this cash value in, go make my investments, make my purchases, buy my services, et cetera, et cetera. So it's got to be designed for this concept.
I mean, you definitely have your dad's energy. I think you may have surpassed him. So I love that. You're very passionate about the subject, very knowledgeable. So, JP, questions off the top.
All right. So let's say I just bought a property today. Let's use this for an example.
Congrats.
Thank you. I had a sizable down payment. Let's just say this is not my down payment, viewers, just so everybody knows. Let's just say I have $100,000 I need to put down on this property. I'm in your position, Hannah, where I can borrow from my own bank. Granted, we've skipped some steps here to get there, right? How does that process look like? If I want to borrow today from my own bank to go buy a property and close on a property.
Yes. Yeah. Hey, and I'll even tell you, because I'm a real estate investor myself, I'm more in the lending side, like the paper side of real estate. That's what I personally love to do. But real quick, this is the whole reason of why I want you to use the cash in the policy. Because if you had that 100 grand just sitting inside of your checking or savings account down at the bank, and you withdrew that money to go give to the down payment, that money's gone, because wasn't that 100,000 inside of your pocket at the bank earning you some form of interest? And so when you go and just pay cash for that, the money's gone. You got to go out there and work for it or earn it somehow to get it back inside of your pocket, making you interest again. So that's why we just add the one additional step of running the money through the policy first, and then I'll leverage against the policy, pull out the cash value, and then go pay the down payment, because now I'm not losing out on that interest, the uninterrupted compounding that's happening inside of that policy. So I'm still earning my guaranteed interest and dividends on that 100,000, even though I'm out here using it in the real world. I don't know of any other vehicle that can do that. I think that's the coolest thing since like sliced bread, but that's my personal opinion. So to answer that question though, how do I take the money out? There's a few ways of how you can do it. I mostly just use my online portal, log in there, request the loan money from there. Or you can call them up over the phone, say, hey, I need to take out $100,000. You'll notice that the insurance company never asks you what you're using the money for, when you're going to pay it back, or how you're going to pay it back. Because honestly, they just don't care. They know that at the end of it, they will get made whole again because we're collateralizing the death benefit. You're just borrowing from your death benefit early. So when I call them up and I say, hey, I want to take out 100,000, they say, okay, do you want a paper check or do you want that direct deposited? I mostly use direct deposit. And then within 5 to 7 business days, that money shows up inside of my bank account to then go and deploy it.
So let me ask on that too. That makes sense to me, obviously. But say you do take 100 grand out of your death benefit. Let's just say for S&Gs, the death benefit was $5 million at the end of the policy, right? Or it is. And I may be using incorrect terminology here, but say it's $5 million. I die in 2 months. My family would still get what at that point? A $4.9 million death benefit? So just it's coming off of that death benefit, correct?
You hit the nail on the head. That's exactly it. They would get the 4.9.
Gotcha.
Okay, let's talk some more real life example numbers here. So if I have $1 million and I'm going to put that entrust that into a financial advisor, and I'm getting ready to retire, and I say, okay, and the financial advisor says, I'm going to get you 5% guaranteed on your money. Okay, so that is 50 grand a year, right? 50 grand a year. Of course, I got to pay taxes on that. So what would be the same amount if I were to take that and put it into this type of program? And we're talking about what am I actually going to make off of $1 million lump sum in the infinite banking, in the whole life.
Pete, I want to ask you, what financial advisor is guaranteeing you returns? Because I don't know of one. So that's one thing I'll put out there.
Okay, let me back up then. If they if they
Project.
suggest that they may be able to get 5% conservatively. I mean, a lot of them will say, we'll get you 10. They'll say 5 is no problem. Hell, we'll do 10 for you.
Yeah.
Yeah, but let's go with 5.
Yeah. So no, just pulling your chain there because honestly, that's why we use the policies too, because it's a guaranteed, contractual guaranteed interest that the company has to pay us. And that's written within the contract. That's just not my flab and gum saying that. So that's why we like to warehouse our money where there's guarantees no matter what's going on in the external world. So in the policy contract, you get a guaranteed interest of 3.25. So 3.25 is what they have to pay you every year. But then when you do incorporate the dividends, because I can't sit here and promise y'all dividends inside of that policy, but with the 6 companies that I do business with, they've been paying out dividends for over 138 consecutive years. So it's a pretty strong chance that they will keep paying out that dividend. So if you incorporate that, it's anywhere from 5.5% to 6% is that overall growth yearly. And that's non-taxable growth. The policy grows tax-free because it's totally backwards to what we've been taught. I want to pay tax on my money one time only at the lowest rate possible, and then get that money into a tax-free environment where now it's growing tax-free and the government's out of my hair.
Okay, so $1 million to you gets me $32,500 plus potential dividends. Is that correct?
Correct.
Yep, gotcha.
Pete, can I go a little bit deeper into that though? Because a lot of people want to look at the policy as this is the investment. The policy is not the investment. Oh my goodness, why would I go put money into a stupid guaranteed 3.25% when I got borrowers lined up outside the door who are willing to pay me no less than 12% to use my money, right? So it's the and asset. It's not the either or. It's not like I'm going to say, hey, I'm going to put my money in the policy or go do some lending deals. It's the and. I'm going to run the money through my policy, and then through the policy, I will go buy my investments with it. That's where the investments are, because in my opinion, an investment involves risk. And what I mean by that is it can go up in value, but it can also go down and lose value. There's some sort of risk there. The whole life policy can never go down and lose value. It's an appreciating asset.
JP, questions, comments?
Yeah, no, absolutely. I'm taking her all in too, just like everybody else, right? Now, how quickly, Hannah, can you access that money? Because I'm investing slightly into one of these right now, and I want to get your perspective too. Like, how recent or how quick can you utilize that money with benefits? Because correct me if I'm wrong, but when you initially invest, let's just go back to the example I had before, $100,000. I technically don't have $100,000 in that policy of cash values, correct? Or am I saying that wrong?
Well, depends on how the policy is designed. If you did a dump in, yeah. But if it's just like straight premium, like in the first year, no, we don't have access to dollar for dollar quite yet. So without getting too deep into it, it's depending on how that policy's built.
Okay. Say it's built for the latter where you don't have access to it immediately. How long does it typically take to get access? Because a lot of the times, like we had somebody come and talk to our real estate investors meetup about this just a couple months back, and a lot of people were questioning, well, like, why would I leave my money in there for 5 to 10 years before I could even pull it out and let it, why would I do that? Right. So can you give us some explanation behind that too?
Yeah. Well, hearing that just off the bat and just knowing here what I'm hearing, it probably wasn't designed properly, because when the policy is built for immediate high cash value and it's with a mutually owned insurance company, you have access to that cash value immediately within 30 days is my definition of immediately. And honestly, y'all, I just tell you within 30 days, but in real life, it's a lot quicker than that. I just don't want to tell you 10 days and you get mad at me when it shows up in 12, right? So I just tell y'all within 30 days, it becomes available to you. I'll even mention just a quick comment on what I just said too, because the company does matter as well. For the folks listening to this, my biggest encouragement is that if for whatever reason you don't like my father's vibe, you don't like my vibe, and but you do still want to do this, I would recommend going to infinitebanking.org, and they have a practitioners finder, and you can see the different practitioners who are educating on this in the proper manner. Okay, so that's my big advice there. So I kind of want to tell you something though. I actually picked this up not too long ago. Well, I say not too long ago. It was back in 2019. Feels like it was yesterday, you know what I mean? But in 2019, I was actually sitting in a think tank. So every year, all of us IBC, Infinite Banking Concepts practitioners, we get together once a year and we sharpen the saw. And I remember Carlos Laura, he has co-authored in a few books with Nelson Nash, The Case for IBC, Your Warehouse of Wealth, How Privatized Banking Really Works. There's just a few of his books. But he got up there and he says, hey, starting a policy is almost like starting a business from scratch. And here's kind of what I mean by that. In year one, if I put $1 into my business or this policy, year one, I will have access to 70% or 70 cents on the dollar. All right, I get it. I didn't break even yet because I just started the business. There's overhead costs, marketing dollars, et cetera, et cetera. But then year two, I put $1 into that business, and now my profits are 85 cents on the dollar. All right, not breaking even yet, but we're trending in the correct direction. Year three, if we're not hitting it, we're pretty darn close. You put $1 into the business, your profits are 95 cents. But definitely by that fourth year, when you put that dollar in, now you're breaking even. You have access to that same $1. That's our dollar for dollar year. And then every year after that, when I put $1 into this thing, now I got access to $1.05, $1.10, $1.30. If you knew that the business was guaranteed to operate in that manner, I mean, how many of these businesses do you want for yourself? And hopefully the answer is a lot of them. And so that's what this policy is. It's almost like starting a business from scratch. By definitely that fourth year is going to be that dollar for dollar break even year. And then every year after that, my profits are greater and greater than the year prior. But I do agree, JP, it's a long-term mentality and thinking. And a lot of people tend to get hung up in short-term thinking, you know?
Right. Absolutely, they do. Absolutely.
All right, you ready? I'm gonna grill you. Now these are some questions from my accountant friend. All right, so we're gonna see how good you are and how well you know your stuff, and we're gonna try and stump you here. Okay. The insurance company is really taking the place of a traditional bank. The premium buys the death benefit, sure, but that is not to my benefit. It's to the heirs' benefit. And if I happen to be single and not have any kids, I may not need that component. So does it still mean something for me?
Ooh, I love this because you know why? I'm single and I don't have children. And if I could leave my death benefit to my 2 kitty cats, I totally would. But see, that's what it is. It's not traditional whole life insurance where I don't have any cash in the first few years and it takes a while to build up that equity in cash. So just quick reminder to go back there is that it's got to be designed specifically on the forefront for this immediate high cash value. And for my analyticals who are listening to this, what we're doing is we're overfunding what's called the paid up additions rider. So as you get deeper and deeper into this world, that word will become more and more familiar. Paid up additions, we call them PUAs for short. If I don't have anybody to leave this death benefit to, I bet there's some charities that you would want to leave some money to. Or worst case scenario, and I shouldn't even say worst case scenario, but let's say that I am that individual that I don't want to leave money to anybody. what you can do is you can literally, instead of taking out loans, withdraw the money out. You can start withdrawing from the cash value, thus surrendering that death benefit until you do hit that zero mark on the death benefit level. So that's always an option of something you can do. But I know, and y'all know this as well, I can't get buried with my money. So I'm going to be doing something with it at the time that I get to that stage. And hopefully I'll have my nieces and nephews. Maybe I'll have children in the future that I will want to leave some of this generational tax-free wealth to.
Mm-hmm.
Okay, what is the borrowing rate the insurance/replacement bank charge?
Yes. Contractually, it states in there that interest can be charged anywhere from 0 to 8%. So that's what's contractual in the contract itself. Now, the companies that I do business with, their interest rate is anywhere from 5 to 6%, just depending on that company. And it's been at 5% for the last 48 years. And that's a whole interesting conversation that we don't have to get into right now. But it's like, why are these insurance companies charging 5% in the times of like the 1990s, right? When interest rates were high. And just real quick, it's because these insurance companies are their own private entities. They are not federally regulated. They're regulated at the state level, and they get to decide how much interest that they want to charge on those policy loans.
I think we touched on this, but just to clarify, if 30 to 40% of the amount paid goes to premium for some future benefit, it would take an awfully long time for the remaining 60 to 70% to get back to even, regardless of compounding.
Let's shed some clarity on this. Because what that comment is saying is that they're thinking that the base premium of that policy doesn't build up any cash value. And that's not correct. It does build up cash value. It just starts to happen in the third year of that policy. So that's why we supplement it and we add on that paid up additions rider. And that's where the majority of the premium is going towards, so that we do have that immediate access to the cash.
And we talked about that 60 to 70% cash value guaranteed interest of 3.25% currently.
That's right. That's
Yeah,
right.
there was a question about that. What has the historic average dividend been, and what has it been the last 5, 10, 20 years on average? I know you touched on that, but one more time.
Yeah. So now here's the cool thing, because the only thing that can fluctuate in the policy is that dividend and that dividend rate. Because low interest rate environments, dividends are going to be lower. High interest rate environments, they're going to be higher. And because we've been in such a low interest rate environment for such a long time, they've been lower. So here, like as of the last 5 years, they've been anywhere from 2.5% to 3%. So somewhere in there, the 2.5% to 3% mark. I even saw one company on one of my policies, I got a 3.3% dividend just last year. So because we've been in those low interest rate environments, they've been lower.
Gotcha. And last two here, I can get a HELOC with tax deductible interest, though potentially higher cost than the insurance might charge. Or I may also get an asset-backed loan, though potentially higher cost than the insurance might charge. How do those two other products compare?
Yes. Yeah. Number one, it's who's controlling the banking function. I kind of hear Nelson in my ear right now talking to me from heaven, but it's who's controlling that transaction is the biggest thing. Because I agree, I will use borrowed money because I know myself and I know I'm disciplined with it and I know how to turn that cash around to make more with it. But not a lot of people are disciplined. It's just like credit cards. Should everybody have a credit card? No, because not everyone's disciplined with the credit cards. But if you know how to properly use them, they can be a great asset for you. So the biggest thing there is that the bankers in control of the transaction, they're going to want their monthly payment on time when they want it, how much they want, and you better be paying it on time because they're in control of it.
Mm-hmm.
One, they're in control of it. And there's another point I was going to hit on. Did I hit on all the points, Pete?
Yeah.
That's another question. Okay.
I think you've been nailing everything.
Okay.
So, no, we appreciate it very much. We're up over 24 minutes. JP, any other thoughts, final thoughts, comments, questions?
I think the only question additionally that I had, you mentioned these 5 companies, 5 banks, or 5 insurance companies that you work with. Are you able to share those with us?
Absolutely. So I would say the top 3, America, O&E America. They're based out of Indianapolis. They also go by American United Life. So that's why you'll hear me sometimes refer to them as AUL. But One America, there's Lafayette Life. And Lafayette, they're based out of Cincinnati. They're actually a part of Western and Southern Financial. There's Security Mutual Life. They're up in New York. So I use them mostly for my New York folks. Because as y'all probably know, not a lot of people like doing business in the great state of New York. So I only really have 2 companies that do business in New York. Then you have Guardian, which is a large one. A lot of people know Guardian. There's Mass Mutual, another large one people know about. And then Penn Mutual, Penn Mutual.
Okay. Heck yeah. I was just curious about that one. I think super encouraging for somebody that is looking to maximize their money without a doubt, and maximize trying to keep a lot of that money in house. You said always borrowing from the family bank. So incredibly interesting concept. And obviously a very vast one as well, that there's a lot to learn about as well.
That's right. Hey, and JP and Pete, if it's okay, I actually wrote a book, and it came out just at the beginning of this year. And to all of your people that are listening, if they send me an email, Hannah, spelled the same ways forwards and backwards, Hannah at themoneymultiplier.com, I'll send them a copy of my ebook. It's called The Single Millionaire Chick. And actually, this is what's been landing me a lot of these like TV interviews, going on Fox LA and different things, just kind of going around promoting the book. But, it's honestly just promoting financial literacy and money mindset, because that's just where it all starts. And we're not taught about that stuff. We're taught a lot about strategies and where do I go find the money, OPM and different things. But it all comes back to how you think about your money, because how you think about the money is going to greatly impact how much money you have. So it's just a gift for your audience.
Absolutely.
That's right. Formal education will make you a living, but self-education will make you a fortune. And this is one of those concepts where, look, guys, listeners, don't always be so skeptical about everything. Don't think that everything is a scam. It's up to you to learn more and dig deeper and find better ways for you to find financial freedom for you and your families as soon as possible. And I think this is one of those ways. So thank you for digging deeper with us on this, Hannah. Much appreciated. One more time, the email
is Hannah, spelled the same ways forwards and backwards, Hannah at themoneymultiplier.
There you go. And you can find them online again, themoneymultiplier.com. Thank you, Hannah. Thank you, JP. Hopefully we send you a lot of business and you can help a lot of folks multiply that money. That's what it's all about.
Hey, and we could do a part 2, part 3. You tell me. I like getting deep into this stuff, all right?
Baby.
Fantastic. Well, thank you for answering all those questions. Thank you, everyone, for watching the Dream Huge podcast. Please remember to like, subscribe, and share. And as always, remember those rules. Work hard, never give up, and dream huge. Let's see the guns, Hannah.
Yeah. I'm in my flowy shirt today.
Thank you, everybody. Appreciate it.
Thank you for listening to the Dream Huge podcast. Make sure you subscribe so you don't miss any future episodes. For more inspiring content, follow us on Instagram and Facebook at Dream Huge Realty and on TikTok at Dream Huge Inc. Until next time.